Hello, everyone. It's Larry Kotlikoff back with Economics Matters, the podcast. And I'm here with my good buddy, Thorsten Slok. And Thorsten is, he's all over the internet because he's like our top economist in the world, really thinking about uh, whether we're going to have, thinking about the macroeconomic conditions, understanding all the different measures, presenting those to people in different forms. Let me just kind of mention a little bit about his background. He's currently a partner and chief economist for Apollo, and Apollo is a one of our leading private equity funds, right? Or am I saying this correctly?
Yeah, it's a $750 billion alternative asset manager. The vast majority is private credit, but we also have 150 billion in real assets. So yeah, so we are the biggest private credit manager in the world, and we also have a very important private equity business. So private markets is what we do here.
Cool. So, and he joined Apollo in 2020, and so we're going back 5 years. Prior to that, he worked for 15 years uh, on the sell side, where his team was top ranked by institutional investor in fixed income and equities for 10 years. So you were working at Apollo before you became a partner and chief economist. Is that
Yeah, so I was working at Deutsche Bank for 15 years,
Deutsche
and
Bank?
before that I was at the OECD in Paris, and before that at the IMF in Washington D.C.
Yeah, it doesn't, the Apollo doesn't want to talk about Deutsche Bank here, so
Oh,
they
that's okay.
they left it out of your bio. But the OECD, just for people that aren't familiar, is a Organization of Economic Cooperation and Development. It was set up after World War II. It's all it's really an economics think tank for all the developed countries in the world, and I guess there are about now 30 now that's been expanded. But any country that's kind of in the game has membership and representatives and a desk at the OECD, and people are talking together all the time. So it's a very important position to be posted there, uh, and working for the IMF is just as important. That's the International Monetary Fund, and he was Thorsten was working for the World Economic Outlook, which is I guess an annual statement about world economic conditions, and but he was focused on China, Hong Kong, and Mongolia. So before all this, he got his PhD at the University of Copenhagen, and during that PhD experience, he spent a year at Princeton. So that's one of the top departments in the world, and a lot of interaction with the faculty there. And as I said, he's publishes journal articles and reviews, and is very much on the guide, the go-to person when it comes to understanding the international scene, the international economic scene. Uh, so he's got an outstanding publication record, but he also is very much connected to what's going on in the real world. And our first question for you, Thorsten, is, are we going to have a recession? And maybe you want to kind of connect this back to the allegations by some pretty prominent people like Larry Summers and Jamie Dimon. Larry Summers, the former Treasury Secretary, former co-author of mine, actually. We were in grad school together. And Jamie Dimon, of course, is the head of JP Morgan. And they were not just saying there might be a recession during the Biden administration, they were pounding the table that it was going to happen. I think Dimon famously said that there was a hurricane coming, and he didn't know exactly when. And of course, the hurricane never came. And you were probably one of the few people that did not predict one. So maybe you want to start us off with that. I'm
Yeah,
not sure.
well, thanks so much, Larry, for having me. And and for that very generous introduction. See if I can live up to the expectations that we have raised here. And also, I remember you and I spoke maybe a year or maybe 2 years ago now, and had a good discussion about the macroeconomic situation. So let's talk about what's going on at the moment.
You're here on number just for your second of many times. That's right.
This is wonderful. I'm honored that I'm invited back. So let's talk about the recession outlook. This picture here is in Bloomberg. If you type ECFC Go, which stands for Economic Forecast Go, you will get to a screen that shows you consensus expectations to the US economic outlook. And there you can click on one question that's asked in the questionnaire of economists on Wall Street. What is your forecast? Then one question that is asked is, what is your probability of a recession in the next 12 months? And you can see here that, as you, of course, we all know too well, when COVID hit, the recession probability, of course, went up in 2020 to 100%. It was very elevated for a very long time. And then after we came out of COVID, the recession probability began to come down. Then, interestingly enough, to what we just talked about, when we then came to the Fed raising interest rates in March of 2022, immediately, as you can see in the chart, the consensus began to say, when the Fed raises interest rates, the economy will begin to slow down. And this is, of course, the issue around that time, that despite that the Fed raised interest rates, as you can see through this staircase, fairly rapidly in a very short period of time, we never had a recession. And the recession probability stayed very elevated for almost a year, where the discussion was around, and I was also at the time very worried about the regional banking crisis in March of 2023. What might the implications be of that? But then after that period and that episode, the recession probability began to come down. And even by the beginning of this year, the recession probability was down only at 20%. Again, this is the consensus view of what is the likelihood of a recession in the next 12 months. And then interestingly enough, now, of course, as you can see, in the last few weeks and the last 2 months or so, we've seen the recession probability go up again. So in the model world of what's going on, I think one way to look at this is that the economy is constantly experiencing all kinds of shocks. Those shocks can be all kinds of things, productivity shocks. Suddenly we are using large language models. We're using AI. There can be terms of trade shocks. And in this case, there can be a monetary policy shock. The Fed raises interest rates. We can discuss if that's exogenous or endogenous, but the Fed raises interest rates is at least somewhat of an exogenous move. And then today, of course, the big question is, well, the shock we have today is a trade war. And therefore, without spending a lot of time on your question here, namely, what is our outlook and the likelihood of a recession? Because the trade war now has been implemented with raising tariffs on China significantly to 145% and 10% on everyone else. That means, of course, that imports from China are going to be significantly impacted. Remember a number of statistics. About 40% of imports from China go to small businesses. And also another statistic, 40% of imports from China are intermediate goods. 60% are end-user goods for consumers, but 40% are intermediate goods. So if we just take this as an example, if suddenly from one day to the other, remember when a container ship travels from Shanghai to Los Angeles, whoever picks up the stuff in the containers has to pay the tariff at the port immediately, before the goods, of course, have been sold in most cases. The consequence of that is that large businesses who have good excess cash, who have working capital, they can deal with this and say, okay, we can either slow down our imports from China, we can pay the bill, because large businesses, say companies in the S&P 500, often have significant amount of cash and significant amount of working capital available simply to pay that bill. Small businesses, however, and remember, small businesses make up 80% of employment in the US, is in companies with less than 500 workers, and 80% of capex in the US is by small businesses. So small businesses play a very, very important role in the US economy. And if now suddenly, let's say I'm an independent toy store in Nebraska, and I have imported a lot of goods from China to sell to my customers, suddenly from one day to the other, if the toys that I'm importing become 145% more expensive, there's some other things here about what is it 145? Is it on the price? Is it on the end price? But the bottom line is, if they become dramatically more expensive, say 100% more expensive in some cases, that of course means that I will not be able to pay the added tariff that I have to pay at the port. Likewise, if I'm a menswear independent store in Wyoming selling clothing to people, if I'm a snowboard gear seller in Colorado selling goggles and snowboards that are produced in China, if I sell that to customers, I will also have problems, and I will also be at risk of going bankrupt. And of course, the retailers who have depended, and remember, there's about 6 million people who work in retail in the US overall, and the retailers and small businesses that have depended on imports from China have just not had enough time to adjust. So that's why the short answer to your question is, Larry, that if tariffs stay at these levels, then our worry is that there's a 90% chance we'll have a recession, simply because small businesses are going to get very negatively impacted. Or put very differently, we spend a lot of time talking about large businesses, S&P 500, but the small businesses are the lifeblood of the US economy, and they are negatively impacted in a very significant way by this shock.
So a couple, comments here. I was listening just the other day to a report about the juvenile industry, which is the toy industry and the baby bottles and all the things for babies, that this company that was a pretty significant size, didn't sound like a super large company, but a pretty major player in this industry, had canceled orders. And he said that others in his industry were also canceling orders from China. Just, it wasn't like they were importing less or they were importing the same and then going to raise the price by 145%, but they were, which is more than doubling the price of whatever, maybe a baby bottle, but that they were just canceling the shipments. They were not putting in new orders. Now, you said something surprising to me, that I was under the impression that if the Fortune 500 were kind of comprised a much larger share of the total capital market, capitalization of the market, the stock market. But you're saying that the small businesses are explaining 80% of the capitalization?
So not capitalization, but if you look at employment, so there's data for how many people work at the S&P 500 companies. Unfortunately, that data is global, but in very round numbers, that's about 28 million people who work in the S&P 500 companies, and total employment in the US is 160 million. So simply in plain English, it is simply the case that the S&P 500 companies, they are very, very important. Apple has people working in Europe, they have people working in Canada, they have people working in, of course, a lot of different countries. But if you take total employment in the S&P 500 companies, it's still only less than 20% of employment in the US. Another way of answering your question is ADP is publishing data for employment by company size. And there you can see specifically how many people work in companies with less than 500 workers. And that's the number I quoted. Namely, they also have a number that is, not surprisingly, but same magnitude, namely around 80% of employment in the US economy is in companies with less than 500 workers. And the other statistic I mentioned is, if you take CapEx, meaning business fixed investment by the S&P 500 companies in billions and trillions of dollars, and you then compare that with total aggregate business fixed investment in the US from the national accounts, we will also find that the CapEx spending by the small businesses, meaning the non-S&P 500 businesses, is about 80% of total CapEx in the US economy. And I know that sounds a bit surprising, because we all think that the Magnificent Seven, wow, they invest a lot in R&D and CapEx and large language models, etc. But if you compare that with business fixed investment across the country in small businesses, it still ends up being that the small business world is very, very important.
Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. and it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, M-A-X-I-F-I, Maxify.com. Now let's get back to the podcast. So if you think about small businesses, what fraction would you say are going to be materially impacted by the tariffs on China? What fraction are doing a lot of importing from China? And China, of course, is also the flip side of this is that China is in the beginning to start embargoing the exports from China to the U.S. So they're doing this with respect to rare earth minerals, so that's going to impact our ability even to produce defense equipment, airplanes, different types of equipment, and capital goods, and then or defense goods, and then we've got this morning we read that they had a kind of a Boeing airplane that had been shipped over, the latest Boeing, to have some final work done, I guess, over in China, and then it was going to be kept there as an import by China from Boeing, and they shipped it back because they said we don't want it. So this is getting to be kind of like a cessation of trade. We're moving in that direction. 145% tariff is, that's saying we don't want to trade with you. And then we've got rumors that Trump and gang are negotiating with other countries, saying that if you have a choice, you can either trade with us or trade with China. And then today we see China in the news saying exactly the same thing. You can either trade with us or trade with the U.S., but be aware that if you do trade with the U.S., you may not be trading with us. Now, if you go to a country like Chile, they do 4 times more trade with China than with the U.S. I don't know what the story is with Europe, but there's a scenario here where everybody says we're going to start working with China. And I mean, do you see that as well, let's go to my first question, which is the share of the small businesses, which you're pointing out are so important to employment in our country, that are really dependent on interaction with China.
Yeah, I mean, there's a number of developments today that are potentially very important. And exactly as you're saying, in our model world, we are basically going to a model where we suddenly have some separate islands, clusters of islands that trade with each other. And this is why this period here is potentially quite significant, because where we will end up, is it the case that we suddenly have 2 separated parts of the world, one that's China focused and one that's US focused, who will be exactly on one side, or is it just going to be more complex? And as to your point, this chart here shows you the share of Chinese exports that go to the US. It used to be that 22% of Chinese exports went to the US. We have already had a fairly extensive period of decoupling, whereby now only 14% of Chinese exports go to the US. So one way of looking at this is to try to look at various statistics in terms of what is the trade between China and the US, and how has that developed more recently. Another way of looking at this is to look at the US consumer. We all know too well that things you buy on Amazon, things you buy in Walmart, in Costco, is likely a significant part of it is produced in China. So how hard is it, as you're saying, to rip out the supply chains we're having today? Well, surveys show that 71% of Amazon sellers, they source their goods from China. This is also telling you that when you and I buy something on Amazon, there's a fairly significant likelihood that is something that was produced in China. So that also tells you how complex it is in terms of changing the supply chains overnight, as is required, or as would be required by 145% tariff coming along from one day to the other. Another way of looking at this is to look at the increase in the average tariff rate by end use. And I know some of these categories here are a little bit special, but if you look at toys, you will see that the tariff rate on toys coming into the US is now going to be on average around 16%, cell phones, appliances, footwear. I know that there are some important exemptions in various trades with various countries, including with China. But this just tells you the magnitude of the increase you could see in prices purely from the tariff going up across a wide range of products. I do understand that goods only makes up a third of the CPI basket, so services may be less impacted, but goods alone obviously could see quite a significant increase as a result of tariffs of this magnitude. Another dimension in this discussion is also the discussion around, well, what is it that we import from China? And do we also import that from other countries? Can we quickly substitute these different products that we get from China with similar products from other countries? And have a look at PC monitors. 79% of PC monitors that are imported into the US, they come from China. That means that it's a little bit difficult. Toys, 76% of toys coming into the US comes from China. Also, again, it's not easy to quickly build a toy factory in the Midwest. It's not easy to quickly substitute with toys from other countries. Laptops, lithium-ion batteries, plastic products, generally 38%. Also, again, telling you that there are some product categories where the price elasticity may be very different simply because there are no other places to go than to get these things
So
from China.
we go back to the prior slide, this one, it's surprising that these numbers aren't even bigger given that the dependence on China for certain types of commodities. But you're saying
Yeah.
that this takes into account the proper weights for Chinese imports of these particular goods.
Exactly. Exactly.
So
And also you can begin to think about substitution effects, that if suddenly the price of toys goes up, maybe I'll substitute towards. So there are some assumptions going into what exactly is the direct impact. But you're right. Also importantly to your question, if I import something, say I import some toy at the border, I have to pay 145 at the price that I pay, not the price that I give to the end user. So this is why the question is, will I absorb as the importer the tariff, or am I going to pass it on to the consumer? So there's some important assumptions about what, and this is why the literature on this is important for how much has the pass-through been to consumers in terms of tariffs.
in a recent posting that you sent around, and I guess people can get your newsletter by signing up maybe you want to tell everybody how to do that.
Oh, just Google Apollo Daily Spark. We put out a daily chart every day. Yep.
Yeah, it's very fascinating. But you're focused on an NBER study, National Bureau of Economic Research study, that's showed that the tariffs that have been imposed on China have been 100% passed through to the American public. And I think we're talking about, so this is saying that the importers are not like taking a hit here. It's really it's not the companies, it's really the end consumer that's getting hit entirely with 100% impact. It's not 80%, not 70%, but 100%.
And which raises a whole new set of discussions around what should the Federal Reserve do then if the ultimate impact of inflation of the current level of tariffs is like that core PCE inflation is going to go up by 1 percentage point over the next 12 months. Remember, for everyone, of course, listening here knows this already, but inflation is already above the Fed's 2% target. We are in round numbers at around 2.5, 3. So if we now add 1% more because of tariff, 1 percentage point, that brings us up to 3.5, 4. And it's very, very difficult for the Fed to cut interest rates when we are moving further away from the target, which is exactly also how Jay Powell has been talking about it, that if we begin to move further away from the target, it's just harder for the Fed, meaning inflation going up. It's harder for the Fed to begin to cut interest rates.
So your prediction, I mean, if based on this NBR study, would you make these numbers in this chart a little bit higher?
I would probably make these, but it all depends on how it's being passed through. So a very important part of the inflation discussion is that these numbers do include some assumptions about what is the pass-through from firms, and we just don't quite know yet. Some firms may say remember profit margins today in the S&P 500 are already at close to all-time highs. So maybe some companies will say, well, we can allow ourselves to take some of this on our profit margin and then not pass all of it through to consumers. But this is where the experiment is playing out as we speak, namely that by definition, you and my textbook would say, well, if we do a trade war, that means higher inflation, lower GDP growth. That's by definition stagflation. And there's a number of just two more links here that I want to highlight. that if you look also at the US imports from China, how is that used? And you could see in this chart here that US imports from China, 63% are final consumption, meaning things we buy on Amazon, but 37% are intermediate products, meaning something that's used to produce Boeing airplanes or F-150 Ford pickup trucks, or if I have a tool company and I get the handle from China and I put together the machine tools in the US, that of course also will begin to have an important impact on my costs if I'm a company and I use Chinese inputs into my production. So the bottom line in these different pictures and several others is that there is just a number of different dimensions in imports from China that become very important when we want to quantify what are the implications for GDP and for inflation.
So let me go back to this question, and this may not be one that's yet answerable, but if you ask of the 80% of the small, medium-sized companies who comprise 80% of employment, do you have a kind of a rough sense of the share that are dependent at this moment on imports or exports to China? Because we have the possibility that China will say no exports from the US, period. And by the way, we're not sending you guys anything either. And then associated, so that's question one or question A, but question B would be if China says to the other countries that it's trading with, if you export anything to the US, you're not trading with us. So we have, we're talking then about countries sending other, intermediate inputs to us, not doing so. Does this whole thing kind of lead to, are we thinking about half of these companies in serious trouble down that path?
Yeah, so as you know, so there's a number of very important aspects of that. So there's about 30 million businesses in the US, but only about 6 million have employment. So if we now think about 6 million have employment and we think about the S&P 500, so 500 of those are enormous, and that's the S&P 500. But that means that the other 5.995 million companies, of course, are small businesses, everything from one-man, independent, self-employed people to businesses that are just below the S&P 500. There is a very important working paper from the Census Bureau that asked the question, this is now a few years ago, did a survey of who are the importers from China. And they did find that the importers from China, meaning what we're talking about, small businesses, is not just a small little group just below the S&P 500. It is actually fairly broad-based. What is the profile of the companies, both in terms of revenue and also in terms of employment size? So the first answer to your question is, it is the case that China is a fairly integrated part of the US economy, and accordingly, of course, for this discussion, for small businesses especially. And the second part of your question is also very important, because the real experiment we're doing here is that the models that you are the world expert in doing is exactly to try to rip out the part that is really straight. So when we rip out that part that is straight and say, well, now maybe there's a risk that it may no longer only just be China, or for China, it may no longer only be the US. Well, given the world has been globalizing and is globalized to a very significant degree for the last several decades, then ripping all that apart and saying, now I need to be self-sufficient, of course, comes with a lot of different economic dimensions. Really, most importantly, let's say in the most extreme case so I happen to be born in Denmark. Let's say Denmark said, I no longer want to trade with anyone in the rest of the world, so this will not happen, but let's take the sake of the argument here. In that case, Denmark would have to produce cars, pharmaceuticals, anything you use in your daily life would have to be produced in your home country. And the risk, of course, is that that will require very, very fundamental change of the Danish economy. And likewise, in the US, it will require very, very fundamental change in the US economy, because there are a lot of things that we import. And likewise, in China, there's a lot of things we import. So it will go completely against my international trade theories and go back to autarky here and have a model where I'm totally self-reliant, maybe together with a few friends that I would like to trade with. And the obvious answer to your question is that adjustment of getting from the extremely globalized world we have today to a world where we rely essentially on only ourselves and a few trading partners that we really want to trade with, of course, comes with a significant risk of adjustment costs that could be potentially very long and very deep. So this is the discussion, namely, is it even possible to do this? without a recession. And if we do really want to do this, what would be the right way to implement that policy? Because the risk of implementing it from one day to the other with 145%, instead of phasing it in over, say, the next 4, 5, 10 years, of course, is going to have very significant implications that are very different as a function of how quickly you allow companies time to adjust to the new world that politicians want us to go into.
Plus, it's going to be very hard. I mean, when they, to import coffee from, yeah, I mean, like to produce our own coffee when we don't actually have the climate, or I don't know, maybe.
And rare earths, as you said, other things, they are simply things we don't produce in the US. So if those things are not produced, and there are things that are not profitable, we don't. So 95% of T-shirts that are purchased in the US are produced outside the US. 99% of sneakers that are sold in the US are imported. So do we want to build manufacturing? Do we want to build sneaker factories? Do we want to build T-shirt factories? There's a lot of things around that's not high value added. So large language models and AI is high value added. So it does raise a lot of questions about the basic structure of what different economies are producing.
I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast. So let me ask you this kind of big question, and then we'll get into more of these interesting stats that are out there that kind of reinforce this issue of this. I mean, 90% probability of recession is, and I guess you're thinking about a major recession, not a small recession, is my guess. But anyway, how crazy is the situation right now? I mean, I don't think any economist in the world, apart from the 3 people in the West Wing of the White House and the guy, the president, who considers himself an economist, I guess, those 4 people have a point of view about how this is all going to work out and how we can be self-sufficient that is at complete odds with any understanding of economics by anybody at the top universities around the world. And so is this just insane? Would you just, I don't want to put words in your mouth, but
to be fair, so let's talk about the growth outlook and what the things are in a minute. But to be fair, I think we all agree that there are some things in international trade, in intellectual property rights, that have been rather unusual for the last several decades. I mean, China has been operating in a different way and at a different level, and as we all know, operating a way where you can only open business in China if you do a joint venture together with a Chinese businessman or businesswoman. So this raises all kinds of issues that it is not unfair to begin to say, well, we need a level playing field here, and we have not had a level playing field in a number of ways. This is shown so many different ways by the OECD and WTO, namely, if you look at also World Bank and IMF, if you look, for example, at the level of tariffs across countries, if you look at non-tariff barriers, it is very clear the US has had the most open economy in the world and most access to consumers, to capital markets, to investments. So it does make sense to begin to say, hey, maybe we should talk about the differences in how this has been approached in different countries. So the only thing we can then begin to discuss is the way this has been addressed, the way that this is then being solved, this problem, that there is not a level playing field when it comes to international trade, is at the moment just unfortunately having some negative impacts on the economic outlook. So to your question, how bad is it out there? If I just, and I know this chart is, I'm embarrassed, it's simple, and I'm embarrassed to show this to you, but let's just go through some of these headwinds that the economy is facing at the moment. Higher tariffs, as we've talked a lot about, is a headwind. Another issue is uncertainty about whether tariffs are at these levels. Are they going to go up more? Are they going to go down? Are they here next week? It has been slightly complicated for companies to do business planning when you have had tariffs coming and going, and we don't quite know exactly what the nature of tariffs will be next week. Is this just a bargaining tool? Is this truly to increase manufacturing in the US? The other thing that we absolutely know also very little about is retaliation. We do know that tourism from Canada into the US is down about 70%. We also know, if you look at the top 10 airports in the US, air travel into the US has been declining in the last 3-4 weeks, also suggesting that even not only retaliation, but also tourism is going to be also a downside risk to
Like
the outlook. And
7%.
retaliation could be all
Yeah,
kinds of things on the services side.
yeah, that's like 7% of our economy, but yeah, keep going. This
Yeah,
is
so
this.
that's why as I go through these bubbles, lower consumer confidence, lower corporate confidence, we also, by the way, have a negative wealth effect. Normally, if the stock market goes down 7 trillion, as it's down as we speak here since the peak on February 19th, normally you and I would sit and talk about what is the marginal propensity to consume out of that shock alone. So the fact that the stock market is down more than 10% from the peak is also making you a bit worried that that there are some downside risks that could be coming along, and that could have some negative wealth effects on not only on consumers, but also on capital markets. And finally, let's not forget, Doge is also laying off workers so far. About 280,000 jobs in the federal government have lost their job. And remember, for every federal government worker, there are 2 contractors. So that means that we also have some magnifying effects through contracts also being canceled. So the bottom line is, there is a fairly long list of headwinds to the economic outlook at the moment. That's why we do add all this together and come to the conclusion that it looks like the probability of recession is unfortunately close to 100, but as we're saying, 90%.
Yeah, I was just checking before we started that the S&P seems to have bought from the inaugurations to today, it's down 15%, if I have that right. The And then we have, I guess we have the dollar having dropped about whatever, 7-8%. And the price of
Yeah, I think it's a little bit more now, but and that continues, of course, to also play out in the background.
price of oil's down 15%. What about the bond market? Let me ask you, we've seen kind of a run on bonds in the sense of dumping bonds, and when you have policy that's kind of irrational, people at the top of the government engaging in irrational policy, and it's not like being paused because we have an underlying 10% inflation tariff across for all countries and 145% for China, which is our third largest trading partner, and it's so important as you're indicating for so many companies, just from one minute to the next, and they're responding, and we're facing retaliation from Mexico and Europe and Canada with respect to the 10%, let alone what Trump was threatening a 20% tariff on all of European imports and 23%, I think, on Japan. So, yeah, I guess the question is the dollar, the dollar's decline, the increase in the decline in bond prices, U.S. Treasuries. Do you see, the end of the dollar as a reserve currency? Is too early to say, probably. And then I guess a kind of more interesting question I wanted to pose with you is the issue of default on U.S. Treasuries. When this whole thing ends up producing a large recession, which I also believe is going to happen, we can't say for sure. We're not going to be as positive about this as Jamie Dimon, but if it does, and revenues go down and the spending stays high, the deficit will get larger. We already have a terrible problem with Social Security that's not going to be resolved by getting rid of the top management at Social Security, which is what they've done. 7,500 people have been fired. A very complicated system and very hard to learn it. It takes years, and they got rid of the only people that know about it. And the software is written in COBOL. So all the COBOL
Yeah.
engineers are probably left and said, enjoy. So do we get this Mar-a-Lago answer, which was dreamed up by Stephen Myron, maybe others have also contributed to that. He's a former student of mine at BU, and he went off to Harvard.
Okay.
Yeah, and then he worked for Fidelity, and then he's ended up as the CA chair. Now, I don't think he would necessarily be, well, anyway, his idea was we should have a withholding tax on, I think that's the notion here, some kind of a withholding tax or fee on the interest paid to foreigners who own our debt. They own a third of our debt. So, do you see foreigners starting to dump our debt? Do you see that continuing? And if that happens, the borrowing costs are going to be that much higher. The deficit's going to be that much larger. That makes the Republicans in the House, the Republicans who care about fiscal sustainability, less eager to endorse a a return to or maintenance of the Tax Cut and Jobs Act. I mean, all this stuff may boomerang on Trump. But do you see it? Do you see the U.S. defaulting at least on foreigners with respect to the debt?
No, I don't see that. And exactly as you're highlighting, the interest rate moves have just been unfortunately somewhat worrying given the backdrop. Normally, so this chart is showing you 10-year interest rates in the US here going back to the last year. And normally, when the stock market goes down, long-term interest rates should also go down. But what is so unusual now is that for a very significant period, including today, long-term interest rates are going up, despite that the stock market, as we speak here, is down 2 or 3%. So this is raising a very important question. Why are interest rates going up when the stock market is going down? And there are, as you outlined also here, really basically two explanations. One explanation is that this is something technical, that there are some discussions around basis trades, some levered swap trades that in hedge funds people have. There was a very important paper by Anil Kashyap that was discussed at the Brookings Papers and Economics activity in late March, where they basically laid out what the basis trade is and how significant it is with $1 trillion in levered trades that potentially is being unwound now as people take down risk. And that results in people selling cash treasuries and therefore putting upward pressure on the level of treasuries. If that is a technical explanation, that the yield is going up for some technical deleveraging reason, then I wouldn't be worried. And I do think that this plays a very significant part is a significant part of the explanation. But what would be somewhat more worrying is indeed if the rest of the world is losing interest in US assets. The problem I have with the rest of the world supposedly questioning US exceptionalism is that I still very strongly believe that the US is the most dynamic economy in the world. We still have the biggest capital market in the world. We still have the best place to raise money, to do AI, to do large language models, to do innovation, to do productive investments. We also still have the biggest military, and we also still have, for that reason, a lot of the things on the checklist to be a reserve currency that really still is in place. But just because we, for the last few weeks, have been looking at a trade war and tariffs that have been implemented, it doesn't mean that we should suddenly change our view of what is the dynamics of the US economy and whether this is a good place to and the best place to get higher returns. It could be, say, that policy, for example, begins to switch towards talking about other things, deregulation or taxes or immigration, healthcare, other topics. And if that's the case, if we do go away from the trade war, I do think that we will then bring back the conversations about that. Well, then the US is indeed again, it will become clear again that the US economy is indeed the best and most dynamic economy in the world. So in short, I do not expect that US exceptionalism is changing over the last few weeks. I do see the dollar going down. I do see interest rates going up, and I do see the stock market going down, and all that at the same time can give the impression that there is something going on, but I think that what's going on at the moment is much more permanent. If this is permanent, meaning the next few weeks, or could it be the permanent really in the next 3-4 years? We can discuss the length and the different views on how long time will tariffs stay in place and what will happen if we do have a recession, including politically, etc. But I will still just leave it at the highest level and say, I still think that there's still a lot of red tape in Europe. There's still a lot of regulation in Europe. There's still a lot of barriers to trade in Asia and emerging markets. And all that brings me to the bottom line that the US is still the most dynamic and exceptional economy in the world.
Yeah, but if we're not trading because we're embargoed and we're embargoing, uh, I mean, I agree that we are, that scenario, that, is fine if we don't have this other state of the world, which is this keeps going downhill. What you're outlining is a situation where there's some rapprochement with China, where China, where and Trump here is asking for China in effect to apologize, to come begging on its knees for us to lower the tariffs. This whole idea that everybody's going to pay homage to Trump. So I'm wondering whether you're incorporating what I would call the Manchurian candidate risk factor here. We have, Manchurian candidate goes back to the movie where somebody is put into the office and he's under control of some foreign power. I'm not sure whether there's a foreign power here that's could be thought of as controlling the president's decisions or the group of, or whether it's his own internal ego or whatever. But we are seeing decisions that economists would definitely say are crazy. And that crazy factor, I guess, he's pushing things to the point where something could break. And I'm just wondering whether there's another LTCM, long-term capital management, which, you recall, was a hedge fund that had a trade on that, and because markets moved quickly, they lost, and suddenly we had major, because so many banks had invested in this company, they were under threat of insolvency, and this was a big crisis. And so the question is whether you've seen anything like that possibly happening. I had a conversation with a former SEC chairman recently who said he didn't know for sure if anything would break, but he thought something would likely break because at some point, if this continued, that this was just that some major company that the government just doesn't have enough information about what is now the kind of a different type of shadow banking system than we had before, but they just fundamentally don't have all the information they might otherwise have to know for sure that there's not that risk out there.
Yeah, so to be totally clear, I truly have no political views. I'm just a bean counter trying to figure out what's going on here. Like most of us, as you know, and you and I in the discussion here, is really an attempt, exactly as you're saying, to figure out if the implementation of the policy is done this way. You and I take our models and textbook out and say, well, if you decide to do it this way, it has these consequences. It could be done in many different other ways, but if this is the way it's implemented, then it indeed has the consequence here, of course, that we're more worried now about the downside. And to your point, then we can begin to exactly look at the question, namely, okay, so how have financial markets been reacting given this shock that came along, that a politician was elected that wanted to do things in a certain way and markets started reacting to that? I have been actually quite surprised at how resilient financial markets have been. The stock market was down 20% at the peak here, and still financial markets have functioned reasonably well, at least in terms of bid-ask spreads in treasuries, and credit have widened out somewhat. But broadly speaking, also in equities, we have had liquidity. Things have been working reasonably good. So one way of looking at this is that we have had certainly a shock come to the economy, and now we're trying to understand the ramifications of that shock. And you're right, there could be that the shock is going to be even bigger, or other dimensions will come to this shock. But so far, it is impressive how risk management at least seems to be holding up quite well. in the financial system with risk, at least not at this point, having any major blow-ups. There was a hedge fund in Japan here 2 weeks ago, but nothing in the U.S. financial system seems to be unstable at this point.
Right. But there are, I guess we have to say, we just don't know for sure
Because
about.
we don't know what expect. So in your and my model world, we don't know the magnitude of the shock, and we don't know the duration of the shock. So if we
But
don't
we
know the
also don't
magnitude
know.
of the shock, and we don't know the duration, it could be much deeper, it could be longer. And if it comes now with the risk of a recession, the nature of the shock will also change, which could then mean that fundamentally earnings, including for companies and corporates and corporate America, could begin to weaken. And then there may no longer be money to pay higher tariffs or pay, for that matter, higher debt servicing costs if interest rates are high and spreads are wide at the same time.
We also don't know, maybe we do. Maybe I'm exaggerating, but if a former SEC chairman says that the government just doesn't know how many, the specifics of positions of hedge funds, but that they're much larger in magnitude in some sense than they were, proportionally speaking, than in the case of LTCM, then we don't know how many of these hedge funds are kind of sitting out there waiting, hoping they can, things won't get worse and maintaining their positions. But then if things, I mean, just imagine that we had some conversations by the president, who likes to scare the economy every minute, it seems, that maybe we should be taxing foreigners on their holdings of U.S. treasuries.
Oh yeah.
What
Yeah, that's
happens?
of course that I mean, saying to current holders of any asset that I may go and take your asset and substitute it with an asset that have much longer duration, say a 100-year government bond that has no coupon or have no interest. With that backdrop, maybe it's not surprising that the existing holders of treasuries begin to worry a little bit about if that were to happen. But again, I mean, technically, remember, if we have a default in the U.S. treasuries, it would be a cataclysmic event for so many markets, and most importantly, derivatives markets that are literally in the notional trillions of dollars that are priced off what's happening in treasuries. So if treasuries have a default, then a lot of derivatives markets would be the biggest problem in terms of what it might mean for financial stability. So I still think that this is extremely unlikely, and I would assign a probability of 0 of that happening, simply because it would come, default of U.S. treasuries would come with so many ripple effects. When the risk-free asset in our economics textbook is no longer risk-free, and suddenly we could default on that. If that were to happen, that would come with just so many significant implications that it would create a dramatic crash in the global economy.
Want more money, less risk, and a better life? Buy Money Magic, a new book by Lawrence Kotlikoff, Boston University economist, personal finance expert, and best-selling author. Whether it's education, career, marriage, housing, investing, retirement, Social Security, IRA, or 401k decisions, Money Magic delivers scores of secrets to raise your living standard. Financial journalist Jane Bryant Quinn says Money Magic is a must-read. Nobel laureate George Akerlof says Money Magic is quite probably the best financial advice book ever written. Financial guru John Malden says, you'll love this amazing book. It's full of wit, wisdom, and startling paths to a better financial life. And columnist Scott Burns calls Money Magic a funny, brilliant read, offering wildly powerful, unconventional choices that can literally change your life. Get Lawrence Kotlikoff's Money Magic today at Amazon, Barnes & Noble, and independent booksellers.
So, Torsten, I would, a couple weeks ago, I would have put the probability at 0 too, but I would have put the probability of a massive trade war with China at 0 as well.
Fair enough. The only thing is that this comes with something that at least from you and my model world, more manageable in terms of figuring out, okay, so let's wait and see, is the economy slowing down? And that's what we are now saying. We think the economy will slow down if these tariffs stay in place. And if that were the case, then we can begin to think about, at least politically, maybe this will continue. If there is a deeper recession, maybe it will not continue. So that's a very different type of shock to deal with, that some politicians need to make some changes. relative to a shock where a default would result in some notional value in the trillions of dollars again of outstanding derivatives suddenly having a very different price as a result of a default on U.S. Treasuries.
So two quick things here, which is one of the things that you put out recently is that it takes once you get into this kind of trade conflict and you have to renegotiate, that it takes like 18 months to resolve. So this trade war with China, even if it does go in the right direction, getting it fixed could take quite a bit. But the second thing, what I just asked you about inflation index bonds, if you're and feel free not to say anything on this, not to answer, okay? But if you're a typical, middle class, upper middle class person, has a fair amount of money in their 401k, and they're seeing the market drop now, maybe it's 20% by the end of today from where it was at the inauguration. Is this the time to think about and getting to safety, which is selling your stocks, buying a ladder of tips? The 30-year tip is yielding 2.6%. That's like 23-year high. Is that a reasonable thing to do?
So without giving any specific investment recommendations, of course, if one has some dry powder at the moment, then at least there's some things today that are a lot cheaper than they were just a few weeks ago. So with that backdrop, yield levels are higher. And of course, consult your financial advisor, but whatever people have in their portfolios, there's certainly some things, in particular in fixed income, that gives higher yields than it did just even a few weeks ago. So without mentioning or recommending any specific thing, I just view this as this is a turbulent period in financial markets. Things will calm down again, and then they will become turbulent again. This is just the nature of what it is. So depending on whether people like equities or what type of equities, or whether they like income in fixed income or in bonds, then there are various different things to do. So I'm, as you can hear, trying to not answer your question by just simply saying that it all depends on what pie chart we all individually have in our own personal economic planning.
Good. All right, listen, thank you. This has been great, and we'll keep at it, and all the best, and keep helping everybody figure out what's going on here.
Thank you, Larry. It's fantastic to check in with you. I hope we'll see you soon, hopefully in a few months or later this year again.